Welcome to Markets Now. I'm Michelle Rook with DuWayne Bosse with Bull Marketing. And livestock futures kind of mixed and two-sided here this morning, while the grain futures are actually back to the plus side. And DuWayne, thanks for joining us. How much of this is just a little bit of short covering? Because, boy, we don't have a lot of news driving the grain markets right now, do we?
Oh man, no, I feel bad. I don't have a lot of news on the grains. It's kind of directionless, which is fine if producers are out in the field. But normally we get some big spikes and movements while they're out in the field, but it sure isn't here yet. That's for sure. Yeah, I think we're just correcting a little bit. We've been down the last couple of days. Now the U.S. dollar a little bit lower today. So maybe we get some money flow back into our grains, and soybeans have been down hard for a week here. We're down 45 cents for the month, I saw this morning. So a little 5-cent pop isn't anything to really get too crazy about.
Yeah. How much of an impact has the dollar had here? I know that we've been reacting to what's been going on geopolitically, but also with fears about inflation and interest rates staying higher longer. But
Right.
is it really having an impact on demand, do you think, at this point, or is it just a perception?
I think more of a perception. I mean, it does long term. If the dollar is going to stay 105 plus for a long term, of course it will curb our exports a little bit. It's just an economic thing. But you mentioned the CPI number in that last week. I think that surprisingly still is catching the equity markets by surprise that inflation's still here. And I got really excited Friday morning watching the trade because I really saw what I believe was a money flow deal where money was leaving the stock market and coming into grains. So I was super excited over the weekend, and then we got to this week, and with the good planting weather, we erased all those gains right away. So didn't see that investment money follow through into the real crops, so it was maybe just a one-day deal.
Yeah, unfortunately, there's a lot of inflationary buying, it looks like, in a lot of other commodities and the softs and the metals like gold and whatnot, but grain really hasn't participated in that at all, has it?
That's exactly right, Michelle. And that's why I was so excited on Friday, because you look at things like cocoa and the metals and some other commodities that have really catapulted up here recently. And yeah, they've got a better fundamental story than corn and beans, I'll admit, but they kind of seem like they've been more of an inflation play than anything. A lot of money just coming into it and inflating it higher than it needs to be. And maybe it's a producer and me wanting to be bullish and wanting corn and soybeans to rally, but I just kind of feel like if money flow leaves the stock market, they're going to look at those two and the charts and realize, that looks like a value and start to put some money in. But like I said, I really thought we had something started on Friday, and we just haven't seen it continue here this week. But I got to admit, too, we need a spark, Michelle. We don't have a weather scare. We don't have that bullish story to get the money going.
And if we get a weather scare this year, it's going to have to be a pretty big one, don't you think, to get the funds out of these shorts, especially when you have a record corn crop last year with all the drought that we had. They're going to have a show me kind of attitude, aren't they?
Well, right. That's been a lot of discussion last couple of years is, producers in the Midwest, we've screamed drought and problems and lower yield, and then we end up with a good yield at the end, the whole better than expected. And, I wouldn't doubt that a fund is thinking like, yeah, I've heard that before. The only difference is, like you mentioned, the funds are horribly short now. You're right. I think it takes something to really scare them out of those shorts, because it does look like our stock should grow year over year with trendline yields. But if you get just even a little bit of weather scare, hopefully it happens in a key state like Iowa, but it's hard to even call Iowa a drought state anymore with the rains they're getting this week. So, but I don't want to sound horribly bearish here this morning either, Michelle. With the funds short the market early in the growing season, something could easily happen to change our fortunes, and then the money flow too. But I say all that, but then today, do I have that bullish spark story for you? Absolutely not. So we just are going to trend sideways at best.
Yeah. And we know the headwind for corn has been an over 2 billion bushel carryout. But for soybeans, let's talk about some of the dynamics there, because we made 1 month lows yesterday. We've bounced, as we pointed out this morning. But you have private estimates for Brazil going up, and the Brazilian real has had a break. How much of an impact are those two things having?
I think all of it impacts our soybean market. The first thing is you got some private forecasters going back to last year's Brazil crop size and raising their crop size, which of course we've been fighting here lately, saying USDA is too high. Look at all these private forecasters in the new crop of soybeans down there. Look at that big spread that, CONAB and that is so much lower. Well, the reason USDA last year stayed higher is they expected more planted acres, and Now, as these private forecasters going back to last year and saying Brazil had a bigger crop size, well, maybe USDA is right and maybe CONAB's wrong. Ultimately, they're going to meet somewhere in the middle, but just them having a big crop, being about 90% harvested, just puts pressure on our markets. Now it looks like their April exports are expected to be higher than anticipated. So, yeah, they're the game in town for China to buy right now, not us.
Yeah, you had pointed out that soybeans have taken out their short-term uptrend line. And so do you think we have to go and test the contract lows or not?
I sure don't think we have to. If we
Okay.
do, I guess I'm going to be a bull at that level, but it is kind of really depressing when I look at the May and July contracts and see that we're closer to the contract lows than we are to the March 30th report highs. That day it felt like we were going to have to buy some soybean acres away from corn. The lost total principal crop acres we've got, soybeans needed more than corn. And now we've dropped. It's almost like soybeans are trying to get rid of the acres. And I think, to answer your question, I think we find support here very soon. And seeing the green today makes me think maybe it's even today that the soybean market can find support. But again, I don't have a bullish story to tell you have to buy it and it has to go higher. I think we're at levels where we don't have to go lower, I guess. So maybe sideways.
And of course, the lack of news is part of the reason that corn is moving sideways in about a 10-cent range?
Oh man, what a narrow range. I had a customer ask me this morning some questions about the moving day averages, where are they all at, what lines up with his positions. And I said, well, all the moving day averages are about the exact same price, 20, 50, even 100 days close, because the market hasn't moved in that long. So horribly boring market. Now, you pointed out that normally when we get in that narrow range, it's kind of like a rubber band that you're stretching tight and it's going to pop one way or the other. But you need that story. But I guess I'm still going to lean towards I'd rather be a bull here than a bear with the setup we've got. Funds being short, growing season in front of us. We all expect a trend line yield and then expect a big crop at the end in big ending stocks. But somewhere usually in the summer, we have some sort of scare that threatens that. And I'm going to bet that that'll happen again.
Okay. Wheat market yesterday, we had the classes going in different directions. And really, it's about weather right now in the wheat complex, isn't it?
It really is. We're planting spring wheat right now, and that puts pressure on that market. And I hate to say, but I think you're going to end up with a little bit more spring wheat acres than anticipated. This is the best spring the Dakotas have had in a long time. So you saw some guys out there in March actually getting some spring wheat planted. But Kansas, is in a little bit drier situation. So, crop conditions there did deteriorate 6%, I think. And I think it could be more this week. But like all good weather markets, we're down a little bit this morning in Kansas City wheat because we see rains forecasted out there. Now, whether they materialize or not, it'll be the direction Kansas City wheat will flow next week.
Gotcha. So as we speak, as I said, cattle have been two-sided, but right now we're seeing a little red on the board. We had two up days. And, do you feel like we have corrected our oversold status now? And where do we go from here?
I'm sorry, speaking over top of you there, Michelle. Yeah, I kind of think so. I'm a bear in the cattle market. And I think, when you think about Friday as hard down as we were, and then over the weekend, we didn't get really any new or worse bird flu cases. It's still up to 28 dairy herds, I think, in 8 different states. So it's not like it's gone away. It's still out there, but we didn't have any more negative news. And, the funds we saw in the commitment of trades report did exit quite a few positions last week. So it's almost like we're kind of bouncing off that, like you mentioned, the oversold condition. Funds have gotten out quite a bit. I still think what we're going to do is just find our upward range and a downward trending channel here, I think, in the cattle market. I'm thinking, I thought cash cattle were going to trade steady this week, but now I'm kind of leaning towards it probably trading a little bit lower by the time we average it out. And packers just seem to have control with the heavier weights, it seems like. So sadly, still a bear in the cattle market.
And we also should point out that we have a cattle and feed report coming out here on Friday. And placements do look like they're going to be lower. But a lot of times we see people, traders getting out ahead of that report because of the uncertainty, right?
Oh, absolutely. We always have big positioning, it seems like, the Thursday. So tomorrow before a cattle and feed report. And those estimates are really mixed, if I could say that. Placement numbers looking to be sharply lower. And when I go back and look at the feeder cattle index over the last month, there were less cattle sold, or at least through the auction sales and on the feeder index side of it. But on feed is still expected to be 102%. So there's cattle there. It's just they weren't placed and marketing was disappointing. So kind of a mixed trade, but I guess if placements can come in as low as 92%, it's hard to call it a bearish report.
Gotcha. Hog market, you mentioned the funds earlier, and I think on the Commitment of Traders report, they were like record long in the hog market. And of course, that was, I think, about the time we had that big bearish key reversal. So where does the market go now?
I guess I'm going to watch the market and the trade action on the chart and say that we've topped in hogs then. Now, it's funny, the market, like you said last week, did that big key reversal, right? So the futures seems like that put a top in long before the cash market did, because really cash kept trending higher until about yesterday when pork cutouts were sharply lower for the first time in a long time. Still very good demand there, but boy, quite often in the lean hog pit, the futures knows what's going to happen before the cash does. And I think we've got to just narrow up the difference between the futures price and the cash, narrow up that premium.
All right. Thanks for joining us, DuWayne Bosse with Bolt Marketing. That is Markets Now.